In other words, use the hyperinflation within the market to your advantage. If you make a shitload of money on equities and then pull that money out, you now have a ton more money in comparison to commodities and consumer goods. The more money you have, the more stuff you can buy. What is the greatest single engine in the world to turn money into more money? The stock market.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
No, stocks do not move with the economy. That's the whole point. The stock market, number one, is a forward-looking mechanism. Number two, it is heavily manipulated and hyperinflated. It is not, inflation in equities is not anywhere near the inflation in commodities and core inflation when you go buy an ice cream or a fucking tire. You know what I mean? It's a whole different point. Absolutely overpriced, but everything in this market is overpriced. It is called inflation, equity inflation. Okay? There is no way to justify Apple losing an entire quarter of revenue, production, manufacturing, and everything, and being 35 to 40% higher than they were before the coronavirus issue. It's not possible that a company is valued not only the same, but 30 to 40% higher than they were before the coronavirus outbreak. However, the Fed has pumped in hundreds of billions of dollars that didn't exist before, and when you introduce hundreds of billions of dollars into equities that weren't there before, that is called hyperinflation. We have hyperinflation within equities right now. That's where it's at. Like it or not, that's what's happening. Let me give you an example of hyperinflation, okay? Here you go. We're gonna take Apple. Okay? If you look at the Apple chart, okay? There you are, buddy. I still got you up there. Okay. If you look at the chart of Apple, right? We can look at Apple going up, hitting 330, crashing down, and now doing this, okay? This was February to April. Okay? What is Apple at right now? Somebody give me Apple price so I don't have to look it up. $375. Okay. All right. I want you to look at this. All right. Before the cases in America even started hitting, the market started dying. Why? Because they were pricing in everything that was lost. Now, the Federal Reserve, the Fed, pumped in close to $1 trillion. How did that happen? They basically printed out $1 trillion, not printed, put zeros in different accounts and said, hey, we're going to give you a zero, use it to buy up equities, okay? And then give it back to us at 0% interest and keep whatever the profit is. Great. Great. Good for them. Doesn't affect you and I. It affects the equities, right? Apple lost almost an entire quarter. Revenue, production, manufacturing, accessories, etc. Now, in order for us to look at Apple and say, wow, it's actually worth 15% more than the crash, then we have to look at this and say, well, then that means even though this company lost an entire quarter of revenue, production, manufacturing, accessories, everything, it's now 3-4 months later worth more as a company than it was at that time. How do you justify that? Well, you can't. Imagine if you owned a restaurant and you just, you had 3 months of nobody showing up, and then all of a sudden on the 4th month, you're like, yep, we got exactly the same amount of customers and money. We didn't lose anything. Everything's fine. You'd look at them and be like, what? All right? You'd be like, that doesn't make any sense. And the reason is that it's not worth $375 in the same way it was worth $330 at this time. This is hyperinflation. What do I mean by hyperinflation? It went down to what, 220, something like that? all of a sudden, the correct valuation, if you price in the amount of loss and on the return, based on what the equity was worth at this time, it's probably closer to 300 right now. Okay? But that's not how hyperinflation works. Hyperinflation is, here's an extra zero. Okay? Take a free $100 million and buy this. Okay, I'll buy this. And it goes to 230. And then somebody else buys it and it goes to 240. All right, thank you. We'll give you your money back. Now the next round, here's another $100 million. Okay, buy. Okay, now it's at 260. Now it's at 280. 300 and up and up and up and up as more money is pumped into there. So what's happening is the amount of money that's being added into the market is new money. It's not money that was already there. It's not a supply and demand of currency like you see in regular inflation. We can't look at the value now as being the same as the value before, because all of this money added in means that there's a supply and demand issue. This is hyperinflation. Okay, you add $1 trillion of new money, then that means that it is at 375 when it should be at 300 because of what the value was before the crash. All right. Now, how does this work? Why is this a good or a bad thing? This is a good thing because equity and real estate inflation does not carry over to core inflation. Technically. So what that means is that you can put your money in here, make a shitload of money that's not worth nearly as much. And how do you know it's not nearly as much? Because now you can't take your profit here and dump it into a different stock that at a cheaper price, because that stock has also gone up on inflation. But you can withdraw the profits from equities and real estate, and now all of a sudden you have more money for commodities because core inflation is at 3% instead of 50 to 100%. In other words, use the hyperinflation within the market to your advantage. When does a bubble pop? Who says it's going to pop? Because remember, if core inflation started catching up with equity and real estate inflation, you're fucked. Because then now this inflation carries over. But right now, the way the rich get richer, because when we look at rich, right? When we look at someone's net worth, it's how much money they can have, how much money they have, and how much money they have determines what they can buy. Mostly for commodities, cars, boats, houses in some cases, groceries, basic necessities, right? So if you make a shitload of money on equities and then pull that money out, you now have a ton more money in comparison to commodities and consumer goods. So that's how we measure worth in money. The more money you have, the more stuff you can buy. What is the greatest single engine in the world to turn money into more money? The stock market. A heavily manipulated, hyperinflated, complete shit show of a bubble. But because this and this are not the same, you use this to generate wealth to pull back and use to buy this. So your 80% inflation in equities does not carry to your 3% in core inflation. It's kind of like having dollars versus rupees, right? If you live in India and you get paid 1,000 rupees a month, you can't even afford to buy groceries. But if you get paid $1,000 a month and convert it to rupees, you now have 70,000 rupees a month. It's the same thing. It's like the dollar and the rupee, right? Make your money in dollars, convert it to rupees, and now you have more and you can buy more. You see what I mean? What do you mean no? Waffle, you don't want the whiteboard? Waffle doesn't want the whiteboard. Sorry, guys. No.